There is plenty of uncertainty around the Middle East peace process, with the ceasefire set to expire in just hours. Joining us now to discuss the potential scenarios for energy prices is Hussein Allidina, head of Commodities with TD Asset Management. Hussein, I know this is moment by moment. We'll have the discussion we have right now, and hopefully it has some legs for more than 30 seconds. But let's talk about some of the potential scenarios you're seeing here.
Yeah, look, so first, thanks for having me. I think the biggest issue here is even in the best of scenarios where there is peace and we go back to normal, normal takes 2 to 3 months to come to fruition. The Straits of Hormuz have been closed for the better part of 50 plus days now. You've got tankers backed up in the Straits. Even if we get back to normal, the logistics around getting those tankers loaded and then to destination and back takes time. If I can bore you with some details, it takes somewhere between 7 and 10 days to get from the Straits to Western India. It takes 20 days to get to Japan. It takes 30 to 35 days to get to Europe. It takes 40 days for a tanker to get to the US. Even if I assume all those tankers that are sitting in the Straits right now are full of oil, it's going to take somewhere between 20 and 80 days to get them out and back. Kuwait, Iraq, UAE, Saudi, those who have shut in production because their storage capacity is full. I have to wait up to 80 days to be able to draw down on my storage capacity to put it onto that boat that's coming back from the US or Europe before I can restart production. And again, the magnitude of the disruption, we've talked about this previously, is unprecedented. We have lost somewhere in the tune of 8 to 13 million barrels a day of production for 50 days and counting. The best case scenario isn't a great scenario.
Okay, so that's the best case scenario. What if we can't get past this impasse? What does it start looking like?
So commodities are supply and demand. Supply is, say, to keep the math simple, 10 million barrels a day lower than demand. Demand is about 100 million barrels a day. If I have that supply gap, I address that by drawing down inventories, which I've been doing over the course of the last 50 days. I address that by curtailing demand. There's some voluntary demand destruction that'll take place in the Philippines, in India, in Europe. There is increased desire for people to work a day from home, to curtail consumption, et cetera. You're not going to ration 10 million barrels a day of demand because you and I work from home a day a week, right? So then the price has to move to ration your demand, to ration my demand. We've talked about the oil burden. Over time, we spend somewhere between 3 or 4% of global GDP on energy. If I go back to 1973-74, Arab oil embargo, 1979-80 Iran-Iraq war, 2008, when oil prices reached a nominal high of $147 a barrel, that oil burden got to 8% of GDP, and we averaged there for a period of time. In today's dollars, that implies a Brent price somewhere between $150 and $200 per barrel to ration demand. We've never had to ration 10 million barrels a day of demand. At the peak or at the trough of COVID in March and April of 2020, global oil demand, when everyone was at home across most of the world, global oil demand fell from 100 million barrels a day to 80 million barrels a day, right? So just to get a sense of the magnitude, I am very surprised that risk markets are trading as optimistically as they are, because even in a taco scenario or in a peace scenario, you have to address the logistics. And again, stuff has not flown through the Straits over the course of the last 51 days. We're talking just about oil. There's natural gas, there's aluminum, there's fertilizer. Those impacts, I think we're going to feel even in the best of scenarios for an extended period of time. And the worst case scenario is price moving to a level that slows economic growth so that our consumption decreases to meet the limited supply that we have.
And even in the best case scenario, is there a new dynamic at play that wasn't before, just Iran's geographic power over that strait?
So there's absolutely, we've always talked about and debated, would Iran close the straits and what that would look like? Well, they've done that now, and they can do that. And it's obvious that it's not super easy to open the straits, else they'd be open already. Medium term, I think that if you're an oil importing country and you don't have a reserve, you're going to build a reserve. Medium term, if you're a Korea or a China or a Japan and you've relied on Qatari LNG to satiate your natural gas needs, you're going to look elsewhere. That's really good for Canada. But yeah, I think the sort of medium-term equation around security of supply has changed pretty meaningfully.
You talk about being good for Canada. Is Canada, I don't want to say capitalizing, you don't want to capitalize on tragedy, but is Canada ready for the moment where the rest of the world looks to Canada and says, wait a minute, you've got oil, you've got gas, can we buy it from you?
Look, we would love to be able to meet the world's oil demand, natural gas demand, fertilizer demand today. We've been in a commodity bear market for kind of the 2012 to 2020 period. We also had a view on commodity production from our prior prime minister that didn't really encourage a tremendous amount of foreign direct investment. I think we're fortunate today to have a government that seems more inclined. They recognize our advantage. Our advantage is that we're a commodity producer. And I'm confident that our Prime Minister and our Energy Minister is very focused on development. We're not going to get the supply in any meaningful way today, but it's quite bullish for Canada because we are going to see investment. And again, when you look at the world and where you can source commodity supply from, not only do we have it, but we're a reliable partner. You can't close the Pacific, so you don't have the same risk that you have in the Middle East. I think it's totally consistent, Greg, to be bullish Canada, bullish the Canadian dollar, and bullish commodities because we're not going to get that supply for 5, 7, 10 years, but we are going to see the benefit in Canada in GDP of the increased investment, the increased activity. Yeah, I wish we had more of it today, but I think it's going to come.
All right. One more question for you here. We're going to switch gears to gold. We understand because of what's happening in the Middle East, why the price of oil has been doing what it's doing.
Yeah.
Why is the price of gold doing what it's doing?
Yeah, look, so there's a lot of folks who claim that gold is like a inflation hedge in the moment or a geopolitical hedge in the moment. I think gold is behaving as it has through history. Gold has weakened of late because you have seen, for example, the Russian central bank sell some reserves in order to shore up some capital. You've seen the central bank in Turkey do the same thing. There's reports that Qatar has done the same. So you've seen gold selling from central banks. If you look to India, they're paying far more for energy, fertilizer, food today. They have less to spend on gold. So from a sort of near-term supply and demand perspective, and the US dollar has strengthened. These things are all sort of near-term bearish for gold. I think the market is providing us with a phenomenal opportunity to add exposure to gold because I don't think that when we come out of this, we're going to be any more constructive of the US dollar. I don't think that emerging market central banks are going to want to hold on the margin more dollars, right? They've been buying gold. That's been part of the structural sort of thesis around why we've liked gold. Emerging market central banks come out of this when things kind of calm down. I anticipate they return to being large net buyers of gold to diversify their reserves, which right now are disproportionately long US dollars.
What's the biggest challenge to that theory? That position?
The biggest challenge to the dollar continues to strengthen, right? We have risk off. If my concerns around what happens with the Straits of Hormuz, what happens to the oil market, prove correct and energy prices move materially higher, you will see strength in the dollar as folks look to liquidate assets and move to a safe haven. That will, in the short term, be bearish for gold for sure. But again, medium term, I have a really hard time believing that when we get out of this, central banks that are sitting in emerging markets that are already sitting with 80, 90% of their reserves in dollars will look to buy more dollars.